Next, we discuss one more small topic. Actually, it is not required in the problematic point of view, but in conceptual point of view, we have to understand what mean by promissory note and differentiation between the promissory note and bill of exchange. Most of the people assume that both are similar, but there is a difference between promissory note and bill of exchange. Now we'll discuss first what mean by promissory note and the features of promissory note. Then we will understand and we'll discuss the differentiation between promissory note and bill of exchange. Let's see here. First, promissory note, before we understand, as we discussed the last time as an example. First, we'll discuss the example here. What is the promissory note? In the promissory note also, the two person will be common as a bill of exchange. Same as person, we will take the another names here like X and Y. Okay, person X and Y. So person X is the money is giving here and the person Y is borrowing. Person Y is borrowing the money. Borrowing the money from the person X. It means for his personal expenses or for personal use, the person Y required the money. So here not any sales or purchase are here. Underline the words. There is no any purchase or sales of goods are here. Just money lending. Here person Y is collecting the amount or funds as a loan, as a borrowing, the cost of 20,000 for example. So obviously we know that when the one person is took the loan and he has to make the payment of interest because of time value of money, he has to make the payment of the principal amount along with interest. Like that, the person A, the person Y is took the 25,000 rupees loan from the person X. It means after a certain time period, he has to make the principal amount and the interest, the cost of amount whatever he has collected, the both he has to make the payment to the Y. So before making the payment, as evidence between the X and Y, the borrowing of money, they will prepare a document and it is called as promissory note. But here the benefit receiver will prepare the document, whereas bill of exchange is different. If you remember the bill of exchange, in bill of exchange A and B, where A is already sold the goods, what he has given? Sold the goods. It means he is the benefit receiver and the benefit giver will prepare the bill of exchange. But here the benefit receiver, because he took the loan 20,000 rupees from the X and he will only prepare the document and that document is called as promissory note. Here promissory means he is promising, one person is promising to the other person that to make the payment. Here order is here. What is here? Order. Who is ordering? Person A is ordering to B as I have sold the goods to you and you are liable to make the payment to us. So this is the order is there in bill of exchange, whereas in promissory note if you observe, one person whoever has already received the benefit, what is the benefit? 20,000 worth of cash or bank balance or some, the 20,000 amount he has received as a loan from the person X. In this situation, the person whoever is already received, he will only prepare this document as a promise. Who will prepare? The receiver of benefit will prepare the promissory note. And the person whoever is received the benefit, he will prepare this document and this document called as promissory note. Now you'll understand, in the money borrowing, the person whoever took the loan from the other person, he will only, the person receiver of the loan will only prepare the document regarding his promise that yes, I am so and so Y, I took the loan from X, I am promising this, I have received 25,000 rupees on so and so date, I am promising to me repayment of this debt amount after a certain time period. This is the way he will promise to the person X and he will make the payment. So this is the why he will prepare the document as source of document as evidence between the money lending between the parties. And this is the oral view about the introduction about promissory note. Now we'll discuss, and here the definition we are writing according to the Negotiable Instruments Act 1881. You have to remember while you are recording the definitions of promissory note, or according to the definitions of the bill of exchange or promissory note, you have to write the year, which is Indian or Negotiable Act, The Negotiable Instruments Act 1881, the promissory note is what? It is a written. It is also in the form of written or writing, not being as a banknote or currency note. It is completely a document and containing the unconditional undertaking. There we discuss unconditional order, but here we are discussing unconditional undertaking. Unconditional undertaking. There was we discuss unconditional order because one person is ordering to other person. But here when we look at the person whoever received the benefit, he is undertaking, accepting that I have taken that amount, I am promising you that I will make the repayment. So that's why it is called unconditional undertaking signed by the maker. He will only sign, whoever is preparing, whoever received, and he will only prepare. Yes, I have taken, I am signing, I am accepting that I have taken the particular amount of money and I will make the repayment. So he will sign the maker and to pay certain money, the certain sum of money to only to the order of the certain person, whoever to his order or to the bearer of instrument. It means whoever have that document. It means either the document holding by the person whoever is given the amount borrowing or the person is ordered to someone other a third party, like that it will be, it is also transferable. Like this is the overall definition about the promissory note. Next we'll discuss about the promissory note features. What are the features it has? Same common features, whereas the some points are common features, some are the different here. The main feature we have to discuss is it is completely underwriting as undertaking condition, unconditional undertaking, or we can consider it is completely a promise. It must be in a written. First one, it is must be in a writing format. Second one, it must be promised to pay. What should be there? Promise to pay. What was the highlight point we discussed in the bill of exchange? Bill of exchange is the about ordering, which is unconditional ordering. But here we have to say promise to pay. One person is saying promise to pay a mere acknowledgement of debt. Debt this is due. The due is not sufficient. The debt amount is has to make the payment. The promising to pay the must some unconditional amount. He is conditionally, it means it should be clearly the amount whatever he has mentioned that has to be paid without any conditions. For example, he paid the 20,000, so instead of 20,000 the person will pay the goods. No, not like that. Compulsory, if you took the amount as a borrowing of 20,000, the person whoever is promising here, he has to make the payment in the form of money only, not in any other forms. Like that it should be, the promise should be must made in the form of unconditional order, and it must be signed by the maker. Whoever is preparing the promissory note means whoever took the loan, they have to be signed in the document. So it must be signed by the maker, that is the person who promising to make the payment, the person whoever is promising to make the payment, and the promise must be payment of money only. This point already have discussed. The payment of the loan, the liability or borrowed money, it should be make the repayment with the interest. If according to the condition, it should be in the form of money only. These are the features. Let's see the remaining features. The amount payable must be in certain, it should be fixed amount. If not like that, depends on time, it will change. The amount whatever they have decided in the promissory note, that amount only they will pay, irrespective of inflation or any other interest charges or all those things. Whatever they have decided according to the promissory note and whatever they mentioned in the promissory note, that amount only payable by the person to the another person. The amount must be payable in certain person named in the instrument of to his order to bearer of the instrument. As I said, this one. As I said, person X and Y is there. Person X will order. It means person Y is signed that I will make the payment. And the payment should be either X or the person C is guided to give another person like Z. So either X or the guided other person is as a third party, the Y has to make the payment, either the bearer of the instrument or the person whatever the indicated by the person who given the loan to the person. So that will be very clearly mentioned. It specify the date. The date has to be mentioned, at what date he has to make the payment, and the date of they have taken, the date of the contract is recorded, the agreement is made, the date of the promissory note is prepared, that should be compulsory mentioned, and if required they should mention the date of the maturity when they will make the payment. Its specific date which is amount should be paid when he is going to pay, that date is compulsory, as well as for the calculation of interest, if there is, that the date of the promissory note is prepared should be mentioned in the promissory note. It must be properly stamped. There should be a revenue stamp or the particular legal stamp should be mentioned in the promissory note. Without the stamp, the promissory note is completely invalid. Remember this point. And it does not need any more acceptance. It means already it is giving by the person whoever is accepting it. It means he is saying that I have taken 20,000 rupees money from the person Y. The person Y is saying clearly, I have taken money from the person X. I will make the payment. I am promising this statement. So there is no need of approval of the X. Already he is saying very clearly that I have taken and I will make the repayment to the particular party. And this is the total overview about the promissory note and the features of promissory note in detail. Let's discuss the differentiation between promissory note and bill of exchange. Already we have discussed the individually what mean by the promissory note and bill of exchange with their features, where we discuss mainly the bill of exchange is an unconditional order by the person 1 to the person B. It means person A to the person B. Promissory note, we took the example of person X and person Y, where the person Y is taking the loan from the person Y and the person X is only preparing the document that promising he is to make the repayment of loan amount. Like that, here the main other differences, the common points are the both are the two parties like that. The bill of exchange contains the unconditional order to make the payment. We have to remember it is unconditional order and we said it is a promise, a undertaking, or it is a promise to make the payment of certain amount. Here the certain amount is common, but it is a order by the one person and it is a promise by a person to make the payment, and here the order by one person to make the payment. The differentiation is here. Here the person is ordering to make the payment to other person. You have to make the payment to me. This is the order here. And here the person whoever received the benefit himself is saying that I have received the benefit. I am promising you I will make the payment. So this is the main difference you have to be remember. So here there are generally three parties as we discussed: drawer, drawee and payee. This is that. But here the only two persons are there: maker and payee. The maker means whoever is prepared the promissory note, the person received the benefit, the person who took the loan or borrowed money, and they called as maker. And the person whoever given that borrowing or loan or advance amount, so the person is called as payee. And here the bill is paid to the acceptor. The bill is paid to the acceptor. But here the promissory note is paid by the maker. Here the bill is drawn by the creditor. Here the amount whoever given benefit is called as creditor. Creditor means the benefit giver. Creditor means the benefit giver. The benefit giver will prepare the bill of exchange, whereas the benefit receiver, as I told you, that the person who took the loan, the person only will prepare, I have received the loan, I have taken the loan, I am promising you to make the payment. So it means here the debitor will prepare the document, but in the bill of exchange the creditor will make the document. Here the creditor will prepare the document, here the debitor will make the document. The next point, the drawer and payee may be the same person. Yes, the drawer and payee. It means the receiver amount. Either when I draw the bill on B as a ordering and I will receive only money, or I will forward to someone. It will be optional. Okay, here the drawer and payee will be mostly same person. But here the promissory note maker and acceptor cannot be same person. Cannot be same person. The bill of exchange is liability of the drawer and secondary and conditional. It means the bill of exchange whatever is there, that is completely a order of conditional, and it is a liability to the drawer, and the secondary it is a conditional. Promissory note is liability. Promissory note is liability of a maker. Whose liability? Maker primarily. Then it is a obsolete. He has to make the compulsory. The bill of exchange can be accepted conditionally. The bill of exchange can be accepted conditionally. So he said the promissory note cannot be made by conditions. So here there is no any conditions, and here some points will be conditionally accepted. In the bill of exchange, The notice of dishonored. This topic we have skipped. Notice, as we discussed that if person A and B are there in bill of exchange, as we discuss, if the person is not make the payment on due date, for example, already goods are sold. What we sold? Goods are sold. The person B has to make the payment. If the person will not make the payment, the person A will take legal proceedings. As I told you, the legal proceedings, the first step is he will send the legal notice, the noting charges. The notice he will send to the B, that will called as noting charges for the spending of the money to the legal expenses. That noting or notice he will send to the person, the drawee, in case of dishonor of bill. That is only present. In bill of exchange, notice of dishonor must be given. But here, the notice of dishonor is not required in case of promissory note. Here, remember, the noting charges or the notice is not mandatory here, but whenever the bill is dishonored, the person, the drawer will send the notice or noting charges or noting expenses he will pay in the dishonor of bill. So we understand in the bill of exchange, the noting charges or notice is compulsory, but in the promissory note, the noting charges or dishonor of notice is not compulsory. And last one, in case of dishonor, bill of exchange must be notified and protested. It will be notified and protested. In the noting and the protection of not required, so here not requirement of protesting and the noting charges between the both, where we understand here the bill of fiction will have more protection and the noting charges or noting expenses in the dishonor of bill. Here it is not mandatory, there is no any kind of notice or the dishonor of protections of the document of promissory note, and this is the over differentiation between the promissory note and bill of exchange. So what is the key factors of the differentiation between the promissory note and bill of exchange? In the sense, only two things we have to remember. In the promissory note, there will be a promise of the one person to make the payment, and in the bill of exchange, one person is ordering, unconditional ordering to the other person to make the payment. Another point you have to remember in essential, as the person, the creditor will prepare the bill of exchange and the debitor will be prepared by the promissory note. And this is the overview for about the differentiation between promissory note and bill of exchange.